Holy fish cakes, you fricka-fracks! Can you believe it? Netflix down 8.5%. $40 a share down in after-hours movement after an earnings report, um, where they just reported the after-hours today. You know what we're going to be doing? We're going to analyze those earnings, take a look at everything they've got to offer, see why this stock is down where it is. If you recall, look, I told you from the start, my current opinion on this earnings. Did not anticipate it to be nearly what was expected, and the reason why, I really don't think the benefit of that password crackdown, the password sharing crackdown, I should say, I don't think it actually benefited them as much as a lot of analysts might have baked in, and really as much as the company itself tried to say that it would. Really didn't feel too confident about that. And hey, we'll definitely have to see by taking a look at these earnings, see if that is what happened here, or if it's just is what it is. Who knows? You never know what happens. So hey, let's get into these earnings. See why this stock's down $41. I mean, that's significant movement. So let's start off by looking at the headlines, seeing if we can see what we can detail from there. Well, first, EPS line of 3.29, $3.29. That's how you would read that if you actually knew how to speak. That's a beat by 44 cents. That's not good. I can't get the Tim Allen here today. Anyways, big beat there on an EPS standpoint, and that's GAAP EPS too. Obviously, the metric I always look at. I don't look at the non-GAAP too much. Then the revenue of 8.19 billion is up 2.8% year over year. Missed by 100 million. Obviously not a massive miss there. I mean, I guess when you consider it, it's not great for him, obviously. I mean, it's a decent miss. I mean, we're talking about at least, a little bit over 1% in terms of miss, probably closer to 1.3%. So it's worth noting that, that is a miss. Now, again, what I told you from the start, the number to look at is really going to be the subscriber data. Because for one, what they're counting as far as new subscribers isn't necessarily going to be during the password crackdown, where they made people who, if you add a household to your account, adding that $8 a month or whatever account really just adds the same subscription as what it counts as, but it just adds an average revenue per subscriber in that sense. That will increase because of that. Now, the main way, look, let's be real about the desired impact of what they wanted to do here. They wanted brand new subscribers paying the $12 a month instead of the $8 a month, right? That's what they wanted. Now, it doesn't necessarily benefit them from a subscriber number standpoint when the people are able to utilize their platform in another household for just a cheaper rate. I mean, there's no reason why people wouldn't do that anymore. I mean, just being honest here. Not trying to game the system or anything. Now, let's just take a look a little bit further on these numbers. Revenue growth driven by a 6% increase in average paid membership, which makes sense there. That's not shocking at all. So, now the global paid memberships, this is the line to look at, increased by 5.89 million to 238 million. 238.39 million. Now, again, good to see subscriber growth in that aspect. Now, one thing I do want to notate, you look at these numbers, and all things considered, this is a business that pays, I mean, regardless of what you're doing on their platform, you're equivalent to the same amount of revenue as anyone else. You're equivalent to the same amount of revenue as the next guy, unless they're part of that family plan, right? So let's be honest, they don't give a, it doesn't necessarily matter. They have to, the only way they really increase revenue, just being honest, increasing the price of the membership and increasing subscribers. So if they're not able to consistently grow subscribers at a really great rate there, you see the revenue start to slip a little bit. And that's where you see this 2.8% growth year over year, right? And why is that significant? Look, my opinion of why this stock probably took a little bit of a dip. You're talking about a company trading at a P ratio over 50 at the current time. P ratio of 50. The market cap, you look at a price to sales basis, right? A company that's bringing in 24 billion a year is trading about at a 9 to 10 price to sales. About 9.5 is what you're paying for that. That's a big multiple that you're paying on this company for one that just posted a growth of 2.8%. And then the real concern is, where is the massive future growth after that? Obviously, it doesn't necessarily happen, right? Unless they grow subscribers significantly. That's the main way to grow revenue at this point. That's kind of the issue with the business that's really segmented in just this way, that's only subscription based. It's nice to have consistent revenue, but the only way you grow that revenue is by growing subscribers or really raising the prices of the membership, which could drive people away. There's not other ancillary parts of your business where you can grow revenue. Every customer is equivalent to the same amount. That's what I said earlier, right? It's not like a retail store where some customers are going to pay hundreds of dollars a week at your store. Some will pay $1 every month, right? So that's something worth noting there. Now, the guidance, not great, right? Revenue expected of 8.52 billion, which is an increase of 7.5%, but the consensus was 8.68. Wall Street here was expecting a lot larger growth in terms of next quarter's subscriber numbers than what Netflix has provided here. Now, maybe they're softballing. Maybe it's true. Maybe they're doing a little bit of a softball estimate. Again, still a 7.5% growth year over year is significant. The only way they really bolster that even higher, again, it's got to be big subscriber numbers. Operating income 1.89. And diluted EPS was over consensus, as you saw, by a decent amount. So pretty nice to see there. Now, look into a little bit of forecast here, right? So Netflix dipped slightly. Yeah, Seeking Alpha, you're not right there. They dipped a lot more than slightly. So on top of that one, oh yeah, for new revenue streams, I get that. Look at that, falling a bit short of expectations. Definitely. Net income saw a fractional year-over-year growth of 1.488 billion. Similar line there. It's one that's kind of hard for them to impact the net income line too much. They do spend a lot, and they try to cut down on costs in terms of content production. But in order to stay relevant, unfortunately, as a streaming service, you have to continuously have new original content coming out, which costs money. Still a pretty impressive line, though. 1.48 billion. You can see on a per-share basis, $3.29 is actually really good. It really is. And the expectations was additions of only 2 million in subscribers. Obviously, look at that. The company no longer will issue its own forecasts. Obviously, there's a lot going on there, and it's hard to necessarily estimate in that standpoint. They can't necessarily provide those estimates, so it's understandable in that perspective. So definitely high over expectations there. But again, that guidance is what's killing them here, right? In terms of the revenue, that's what's killing them. Free cash flow, very nice. It boosted the free cash flow forecast for the full year to at least $5 billion from the estimate of 3.5. That's significant, $1.5 billion increase there. So really nice to see that. If you're a shareholder there, increase that. That line could be really good for them, right? Could be really good. So yeah, right now I know that they are doing a video interview at the current moment, so we'll see what that looks like. But as you see right now, not really helping the price of the stock, that's for sure. Let's get into a little bit further detail. What is that further detail? The investor letter. Let's read the investor letter, see what they have to offer for us. Again, worth mentioning, this is the main summary. In May, they launched the page sharing in 100 plus countries, which represent more than 80% of the revenue base. That's where it hurts, right? That's where it hurts. In those 100 countries, 80% of the revenue base, and they might include this. They might start doing sharing, right? So that's wild. That's wild to see here. Other highlights, obviously, we saw that data already. They do, they want to put something good in here too. So they're the leader in streaming engagement. And per Nielsen, we had the top original streaming series in the U.S. for 24 out of the first 25 weeks. of 2023. I don't think they have a lot of great originals. Let's just be honest. I don't think a lot of these places do, just because they have to push so many out. There's not a lot of whole good originals. I mean, if we're being real with each other, I mean, and I'm going to be real with you. Yeah, they have more work to do to reaccelerate growth. Obviously, as I mentioned there, that's something they're going to have to do, right? Ugh, no doubt about it. And here's where you get into this line of year-over-year growth. This is a line that a lot of investors are going to be looking at. You see, so far it's been pretty well consistent decline on an annual basis as far as the growth rate. Now, threw up in my mouth there. Pretty disgusting, and I'm going to brush my teeth after this. What the freak was that? Now, again, next quarter, look at that line. Expected to grow 7.5%. Pretty significant. If they don't hit that line, scary to see. But they expect to be consistent as far as the net income here and as far as the just operating margin. Very consistent line on a quarter-over-quarter basis, so worth noting here. Now, again, like we see, they don't give forecast here for subscribers. This was an 8% growth there, which is nice. A lot of it going to be tied to, like I said there, the family sharing plan. So, yeah. As far as shares, a slight decrease in shares outstanding, so not too bad. Year over year they are up, but it's not really that noticeable. I'm not too concerned there. Forecast, we talked about the forecast. Listen, engagement, here they go talking about it again. Satirical dramedy beef. Who the heck is Ali Wong? I know Stephen Yoon. What the heck? Who names a show Beef? Who names the show Beef? And Love is Blind. People watch that, but man, let me tell you, it ain't. I don't know. I guess I don't know who's watching that, but it's interesting. Someone doing some weird stuff there. They're enjoying it. Anyways, we move on. They just talk about all their originals. I get it. Okay, we get it. You got a bunch. They're still going on about it. Here they go again. Squid Game Season 1. Look, that's old, folks. That's old. Get out of here. That's old. Here they go. They just keep going at it. Anyways, look at monetization and revenue. Really nothing I wanted to note there. Now, one thing, you know what? I just said there's nothing to note. There is. Kind of like I said, advertising is something they want to get into. So it will offer consumers a lower price point. They have a lower price point model now, which is going to be cheaper on a monthly basis, but it has ads. Now, that's nice, obviously, for them because they can earn a lot more money on those particular subscribers. Now, again, I don't think most people will opt in for that plan. Some will. Some certainly will. And that benefits Netflix the more people that are on that cheap plan. Let's just be honest with each other. As ad rates continue to recover, Netflix wants more people on that ad-supported platform. They don't want people on the free one. Just being ultra real with you. Looking at this vacuum, what the heck? My new vacuum, it's in the wrong spot. I swear it was flipped around. But yeah, they want people on this platform. The thing is, they don't give us necessarily a breakdown of who's on what, but that's all right. Talk about competition. Nothing crazy to note there. I mean, these are pretty well-known lines here. Main competition. There's just a bunch of different players out there. U.S. screen time. Look, Netflix at 6%, quite significant. YouTube down there. Disney Plus, not really close on that standpoint. Netflix is really second fiddly, or really close to YouTube on that standpoint in terms of just streaming. So. Yeah, and that's including YouTube TV with live streaming. So, yeah. Cash flow, capital structure, I get it. Let's get rid of this one. Environmental, social, and governance. That's just the most useless section ever. Regional breakdown. I've looked through this. Nothing I really care to share too much about there. I mean, it's not really anything crazy. Pretty consistent. You saw a slight decline in Europe year over year. That's maybe worth noting. U.S. revenue flat. I guess we can talk about that too. Latin America down slightly. Asia Pacific down 13% in revenue. Not a massive core of their business, though, so that's all right. Let's get down to none other than the show me it, show me it, show me it, show me it, show me it. Oh, baby, here it is. Balance sheet. I love a balance sheet. They give me a 6 months balance sheet, which I can accept. I like a year over year. I do. But I can take a 6 months. Um, so let's start looking at total assets in general. 50.8 billion versus 48.5. They grew the total assets on the company by a little bit over 2 billion. Pretty nice there. From a liability standpoint, that stayed relatively flat, 27.9 compared to 27.8. That stayed relatively flat. They grew quite a lot more assets than they did liabilities in the last 6 months. And why do I note that? I love to look at shareholder equity. Total shareholder equity at 22.8 billion compared to 20.7 of just a 6 months period ago. $2 billion increase in equity. That's pretty nice. That means that's you as a shareholder. You own that, right? That's you. It's something they could utilize for obviously research and development. Maybe pay you a dividend down the line. Who knows? Maybe pay a special dividend. You never know. But that's a good line to see. I like seeing that as well. As far as the earnings, that's kind of what I got. Look at this thing. It's plummeting. But hey, you know what? It's kind of because of the price. Again, like I said, I think it's just because it hit a decent wall here. It's priced at a very high multiple, and it's not necessarily bringing in the growth that it used to. That's what I got for you. You have a great rest of your stinking day.